want to get to our next guest and bring in Seth Denson, who is the co-founder and chief strategist over at GDP Advisors. Seth, good to have you here with us this morning. I want to know, as I'm kind of breaking down those sectors and what I'm keeping an eye on, which sectors you're watching this week as the second quarter rounds out.
Yeah, you know, Brad, I'm still looking at inflationary hedges. I'm looking at commodities, gold, oil, some real estate, some REITs. I think that these are all areas that are going to do well, at least in the short term still, based on where we are. Agriculture is another sector we're looking at to see how that's going to perform overall. And then kind of the going out stocks as we continue to open up the economy and people are getting out there. I think that those are going to do quite well.
Okay, and so going forward from here, as we are continuing to monitor not just what we've seen in the past few weeks on the employment situation side, weekly jobless claims coming in a little bit worse than anticipated, but overall, largely the trend has remained intact in terms of where we are heading. We are going into and in the summer months right now where you've seen people get back out there, either going back into certain experiences or even in the retail equation as part of that. And so where specifically do you see the most opportunity where there are still some of the consumption trends that are staying locked in, but then additionally some of these broader experiential reopenings that are coming back on the table for many households?
Yeah, Brad, you know, with 23 states opening up and cutting back on the, we'll call it the unemployment gross up, I think you're going to start to see a lot of the sectors like restaurants, clothing, retail, malls, things like that going back because they're going to get workers back. When you get workers back, people are going to have bigger experiences. Listen, 80% of restaurants right now are saying they're shorthanded. And so while those unemployment benefits are going to be extended in many states through September, till September, I think with these 23 states opening up and restricting those, I do think that that's an area to watch as it's going to continue to grow.
Okay, and so from here, I mean, I'm looking at, as we were taking a look at a few of the earnings that kind of come in towards the end of the earnings season. Last week, we got one of those major bellwethers in Nike that kind of gives us a little bit of a sense of what consumers are thinking through right now. Consumers are having to monitor this inflationary environment as well, to the extent that they are seeing prices for things that they purchase on a weekly basis or on a more largely cyclical basis as well. They are looking at those prices higher than a year ago, higher than even some pre-pandemic levels as well. And so what do you expect to hear further from either Fed officials or from the powers that be that have the opportunity to set policy that would counteract some of the inflationary concerns that are on the table right now?
Well, what I've learned to expect from Jerome Powell and the Fed is don't expect too much, because when you do, most frustration comes from unmet expectations. And nonetheless, I think, listen, the Fed is in a really precarious position. They're balancing a really rocky economy on the, you know, just because of the shutdown and the lag in certain sectors. But I think if the Fed had its way, it would raise interest rates. And certainly they've indicated now that in 2022 that they're likely going to do that. I think they need to do that. I think for the average consumer, though, they're watching the basics, right? What are the core food products, energy, fuel, those types of things? I think that's certainly something that's on the minds of most consumers. Listen, 5% isn't going to stop people from buying Nike shoes. But later this summer, as those other things start to creep up, you know, people might pull back and that consumer confidence might go down a little bit. And that could be a really rocky position for the economy going forward. And I think the Fed is looking very closely at that as they're trying to weigh what things they might do at the end of the third quarter.
How do you hedge against inflation for your own portfolio?
Yeah. I mean, certainly, and I will say this, you've got to hedge against inflation now with the expectation that interest rates are going to go up because that changes your mindset a little bit. But listen, commodities, raw materials, raw production, mining, things like that are typically good. Again, I'm looking at REITs right now. I know that there's a lot of emphasis on cryptocurrencies. I'm not a crypto guy. It's just too volatile and it's unregulated, and I like a little bit of regulation when you're talking about things like crypto. I think that that's coming. It's just not here yet.
Not even crypto curious stuff, Seth?
I'm not there yet, man. I'm watching it. I know it's what all the kids like, but I'm getting older. So, you know, I'm starting to kind of slow down a little bit and play the long game.
Additionally here, Seth, while we've got you, when we think about the infrastructure deal, bipartisan infrastructure deal, it looks to pass as long as the reconciliation package is included. The industrials, is that the only sector that you're keeping an eye on with regard to infrastructure, what that could mean economically going forward?
No, listen, I'm looking at a lot of the ancillary supportings. Like you've got chemicals and water production. That's going to be PVC plastics. You've got companies like Northwest Pipe, Lithium Americas Corp. You've got fiber optic producers. That's going to be part of this deal. I think that's good. President Biden wants 173,000 miles of roads that needs repair. That's going to be materials, asphalts, things like that. All those ancillary supporting sectors, I think, are going to be really good in this infrastructure deal goes through.
Just to end where we started off this conversation, as I was, telling our viewers, the week that we came off of and new records for the S&P 500, we open at a new record high today as well. S&P 500 at a 14% year-to-date gain. Do you expect this growth to continue, and what would continue to be the catalyst that locks in this trend?
Well, yeah, I do expect it to continue. I think most projections, and I kind of agree with them, are that the S&P is going to end around 35% this year. Now, let's put that into perspective. We focus back on 2019. It still had growth. This last quarter, seeing about a 60% growth. Well, that's up only about almost 9% from 2019. But listen, be cautious. People are emotional. It's going to bounce. Trends are going to be up. But those are the things that I'm watching for and is watching that volatile market just based on emotion that's in it.
Would earnings in the next quarter coming in below some of the anticipated levels, given that it's expected that many companies had to pull forward results to make sure that not only were they able to stay in good favor with investors, but also so that they could themselves weather this tail end of the pandemic? And so with that in mind, what are you watching for from earnings in this next earnings season that's upcoming in as we're wrapping up Q2 right now?
Yeah, listen, we're seeing a lot of lagging indicators, so I'm still waiting to see what the quarter three is going to hold from a recovery perspective. And that's what I'm saying. I'm not making rash decisions. I'm not moving a lot. It's a lot of hold right now and just kind of see what's going to happen. I think that's the best bet for a lot of people. I always say play the long game, not the short game, unless you got money to lose.
Seth Denson, who's the co-founder and chief strategist over at GDP Advisors. Thanks so much for the time this morning, Seth.